Good morning, everyone. Today we walk you through our investment analysis of GoTo, Indonesia's largest digital ecosystem. We'll assess its transformation journey, financial fundamentals, and valuation outlook, and ultimately what this means for investors. Formed in May 2021 through the merger of Gojek and Tokopedia, GoTo integrates services across three core verticals: e-commerce, on-demand mobility, and fintech, operating under Gojek, Tokopedia, and GoTo Financial. The company's vision is to make the digital economy accessible to all Indonesians, and its mission is to empower users, whether consumers, merchants, or drivers, through technology and innovation. GoTo's operating philosophy is grounded in three key principles. It's a customer-centric approach, effective stakeholder management, and an ambitious winning mindset. Now, looking at its performance following the TikTok acquisition in 2024, the financial services saw a 65% transaction volume growth, driven by a rising adoption of digital payment and embedded finance. Meanwhile, on-demand services only grew about 13%, signaling a mature market. The slower growth is likely reflective of price discipline and strategic pivot from GMV to profitability. Let's walk through the GoTo strategic evolution, which is represented in the next slide. In 2021, GoTo was born through the $18 billion merger of Gojek and Tokopedia, Indonesia's biggest tech deal. This merger was a strategic defense against competitors like Grab and Shopee, and it attracted 1.3 billion in pre-IPO investments from global players like ADIA, Temasek, and Tencent. But in 2022, reality hit stocks hard. GoTo stock plummeted 44% below its IPO price. In response, the company began massively restructuring its operations, divesting in non-core assets, slashing marketing spending by 43%, and cutting over 1,800 jobs to regain investor trust. Then came in the 2023 profitability acceleration. Under the new CEO, Patrick Waluyo, GoTo shifted aggressively towards monetization and cost control. As a result, EBITDA improved 72%, and the company offloaded 75% of Tokopedia to TikTok to ease costs and double down on fintech. By 2024, GoTo has achieved break-even EBITDA and set a new guidance of 1.4 to 1.6 trillion rupiah, showing that Waluyo's principle of revenue optimization and absolute cost management are driving real change, and this is reflected by the investors' forward estimate. Forward looking by 1 year, there is three is estimate that I have placed here. Firstly is Fintel, who estimated that GoTo stock will be 97 rupiah by the end of the year. TradingView estimated that stock will be 100.25 rupiah. And Market Screener estimated that GoTo stock will be 101.90 rupiah, which generally suggests a positive outlook for GoTo stock price over the next year, with target prices ranging from approximately 92 to 102 rupiah on average. Next slide. An analysis on the fundamentals. Is GoTo going the right track? First, revenue has grown consistently since 2018, which is the strongest growth occurring in 2021 and 2022 of 150%. While growth slowed to 8% in 2024, this reflects a deliberate shift from aggressive expansion to sustainable income generation. Second, EBITDA improved significantly in 78% in 2024 following Patrick Waluyo's appointment as CEO. This jumps highlight the success of GoTo's cost control and monetization strategy under new leadership. Finally, the operating margin, which has been negative for years, turned a corner. In 2024, GoTo reached a break-even, improving by 120% year over year, a key profitability milestone. The red line across all three charts marks the strategic inflection points under Waluyo. Since then, GoTo had transitioned from a growth at all cost model to a more disciplined, margin-focused execution, creating compelling turnaround story for long-term investors. GoTo remains a high-risk stock, however, with volatile returns and sensitivity to earnings guidance. Leadership changes and execution. Despite a strong rebound in 2024 to 2025 with sharp ratio of 18.71 and annualized expected return of 1,076%, and its long-term return is still at a minus 66%. GoTo faces systematic risk from Indonesia's macroeconomic environment and unsystematic risk from past negative earnings and high reliance on monetization strategies. And to reflect this, we have decided to apply a 1.5% added premium in our DCF valuation over the risk-free rate that is determined. So let's now evaluate GoTo's valuation relative to its peers, Grab and C Limited. GoTo has the highest price to sales ratio at 5.6, making it the most expensive on a revenue basis. However, its operating margin is functioning at a negative 4.48%, unlike Grab and C, which have positive margins. This suggests that GoTo isn't converting revenue into profit as efficiently as the other two, making the high price to sales ratio hard to justify. Now, looking at its price to book value, GoTo sits at a comfortable 2.71%, higher than Grab, but well below C's 7.31. But what's more concerning is that GoTo's return to equity is minus 16.3%, showing poor return generation, while C delivers a healthy 5.9%. From this, we see signs of potential overvaluation. Investors are in fact paying a premium for a company with negative margins and ROE, likely driven by optimism around its turnover. While Grab is priced more modestly with positive metrics, Z combines both profitability and strong valuation, positioning it more soundly. In conclusion, GoTo's valuation may reflect investors' confidence rather than fundamentals, suggesting that price adjustment or further internal improvements are still needed for GoTo. So the following slide represents the DCF analysis for GoTo. We project a free cash flow over 10 years using an 8% terminal growth rate, which reflects Indonesia's risk-free rate plus the 1.5% risk premium that is mentioned previously on slide 5, as justified in our risk slide. The operating margin assumptions are benchmarked to Mercado Libre, a South American peer with a similar business model who has an operating margin of 13.35%. And based on this assumption, GoTo's projected terminal value is approximated at 300.76 trillion rupiah, signaling strong long-term potential if current improvements sustain. And now using a 10.4 WACC and 8% terminal growth, our DCF yields an implied share price of 71.35 rupiah per share, which is below the current price of 82 rupiah per share. This suggests that GoTo might be slightly overvaluated, with current investors' sentiment outpacing fundamental value, likely driven by optimism around its ongoing turnaround, as previously mentioned. But does this mean that investors should pass on GoTo? Not necessarily, because here are the implications towards interested investors. Despite the long-term uncertainty, GoTo is no longer just a growth story. It's in fact a transformation story. With proven market leadership, positive adjusted EBITDA, and structural tailwinds in Southeast Asia, GoTo is now leaner, much more stable, and ready to scale to larger heights. We recommend a strategic passive accumulation strategy, gradually buying through dollar cost averaging. This reduces timing risk, captures long-term upside, and allows investors to benefit from dips in volatility. In short, investors should buy slowly and hold confidently. To close, GoTo represents more than just an investment in a tech company. It's a stake in the digital backbone of Southeast Asia. Yes, there are risks, but behind the volatility represent business in transformation, one with improving fundamentals, sharper leadership, and clear operational focus. Our analysis shows that while current valuation might be slightly ahead of fundamentals, the direction is right. Thank you for your time. Thank you for your time. That's all from me, and we welcome any questions relating to any analysis that we have presented today. Thank you very much.